Namaskar. My name is C. Ashutosh Limaye. Welcome to Dhyan Vishnu CA Academy's YouTube channel. In this video, we will be discussing about the cost of capital. We will break the entire topic into 3 to 4 videos. If you are into business or you want to start a new business, you must be aware that how the money is important in the business. If you want to expand your factory or you want to start a new project or you want to replace an old machine with a new one, money is required. You can put your own money into the business, or you can get the investor to invest in your business, or you can obtain a loan from the bank or a financial institution. But one thing is very clear. Each penny invested in the business has a cost. If you do not invest your money into the business, then what you will do with the money? Obviously, you will invest into mutual fund or you will invest it into the fixed deposit. If you have not invested your money anywhere, then your money must be laying in your bank saving account and earning some interest. When you are putting your money into the business, you will lose the interest income. So it will become a cost for you. Similarly, loan fund is also having some cost. Whenever we do business, we arrange money from the different sources and put that money into the business. The money coming from the different sources has a cost. When we combine the cost of all the sources, then it is called as cost of capital. So what is cost of capital? How the cost of capital is calculated? How the cost of capital help in evaluation of the project? All this we are going to learn in this video. So I request you to watch the entire video from start to end. So let us start. FM Concepts, Cost of Capital. English, Lecture 1. Introduction. First of all, we will understand what is cost of capital. Let us start with an example. Suppose we want to start a new project. So whenever we say we want to start a new project, we require investment in fixed assets and working capital. So fixed assets include land and building, plant and machinery, office equipments, furnitures and fixtures, vehicles, and some investment in working capital. So total investment required for this project is 100 lakhs. Now, what are the various sources of finance available for this investment of 100 lakhs? The first obvious source of finance is the owner's fund. So in our example, the owner will be contributing as a capital rupees 40 lakhs. So whenever anybody invests in a business, he must have some expected return from the business. So the expected return of the equity shareholder or equity holder is 12% per annum. So this expected return of equity shareholder is a cost for the company. So in short, this is a cost of equity of 12%. Total investment required for the project is 100 lakhs. Out of that, the 40 lakhs is coming from the equity finance and the balance 60 lakhs will be from the loan fund or a debt fund. Long-term borrowing is 60 lakhs. And what is the cost involved in that is 6%. For the 60 lakhs of loan fund, the cost associated is 6% interest cost per annum. In short, for the equity fund of 40 lakhs, the cost involved is 12%, and for the debt fund of 60 lakhs, the cost involved is 6%. So what is the total cost of the project? For calculating the total cost, we need to make the proportionate cost for the each of the source of the finance. For equity finance, the proportionate cost can be calculated. The 40 lakhs, that is the investment from the owners, total cost of the project is 100 lakhs multiplied by the 12%, the expected return by the equity holder. Proportionate cost for the owner's fund or equity fund is 4.8. Similarly, the cost of the debt fund is investment from the debt fund is 60 lakhs, total cost of the project 100 lakhs multiplied by the cost per annum associated with debt fund, that is 6%. Total cost of the debt fund is 3.6 6%. Now the total cost of the project or total cost of financing is 4.8, that is equity, plus 3.6, that is debt. So the total cost of the project is 8.4%, and this 8.4% is called as cost of capital. Now we will summarize what we have learned in this example. So what is the cost of capital? In short, the cost of capital is return expected by the provider of long-term finance. In other words, the consideration paid to the financer for using their money into our business is called as cost of capital. Generally, the cost of capital is expressed in terms of percentage. 10%, 15%, like that. The cost of capital is also known by different name. It is also known as cutoff rate, hurdle rate, required rate of return. Cost of capital is a minimum required rate of return that we need to earn from any project. Suppose the cost of capital of a project is say 10%. As we know, the cost of capital is a cost required for bringing that money into the business. So it is a 10% or return expected to be earned from the project, that is ROI, is say 8%. 8% is the ROI. So the return expected is 8% and the cost associated is 10%. It means we need to reject the project, as there is no point in doing the business, because we will make the losses. The cost is 10 and the return is 8%. It means the cost of capital will help us to evaluate or take the decision whether to accept a particular project or reject the project. Now we will see what are the various long-term sources of finance available to us. Broadly, the long-term sources of finance are subdivided into two parts: owner's fund and loan fund. So if we further drill down the owner's fund, the first in that is the equity capital. So what you mean by the equity capital? Equity capital means the capital contributed by the owner of the business. These are called as the equity shareholder. These are the ultimate owner of the business. The next is retained earning. Retained earning means some part of the profit kept aside for the future benefit or future expansion of the business. That reserve is called as retained earning. And this is the one of the source of long-term finance for the company. Next is preference share capital. So what you mean by preference share capital? A preference shareholders are also the owner of the company. But the difference between preference shareholders and the equity shareholder is that preference shareholder do not have voting right. But the preference shareholder are having the fixed rate of dividend. Their dividend percentage for the year is already decided, and preference shareholder are having the preference for getting the dividend over equity shareholder and even the repayment of the capital at the time of liquidation of the company. Next is loan or debt fund. This loan or debt fund include debentures, bond, then the long-term borrowing. So the long-term borrowing from banks and financial institution is also included in loan or debt fund. Consideration paid to equity shareholder is called as equity dividend. Similarly, consideration paid to the preference shareholder is called as preference dividend, and the consideration paid to the borrower or lender is called as interest. So the total of all this consideration paid to the financer is called as cost of capital. I hope all of you like this video. Please like, comment and share the video. And if you have not subscribed to Dhyan Vishnu CA Academy's YouTube channel yet, then please subscribe it now. Your like, comment, share and subscribe motivate me to create new videos. If you have any questions, queries, doubt, or you want us to make a video on a specific topic in finance, please comment below the video. You can also mail us on dhyanvishnucaa@gmail.com. That's all in this video. Thanks for watching. See you in the next video. Till then, thank you very much.